A few weeks ago, I came up with this concept of buydowns are the bomb. I've been talking a lot about temporary interest rate buydowns. And I have another really good real life example that I'm actually working on right now. This is a situation. I got a call from a past customer literally 2 days ago. Their existing home, which I put the loan on that about 4 years ago, they've got it in escrow. It's going to be closing soon. So they're looking to buy another home near this market area. In fact, what they're looking at is a single family residence. It's featuring 4 bedrooms, 3 baths, 2,602 square feet. It's listed in Beaumont, city of Beaumont, which is just west of here in Palm Springs. It's listed for $575. It was built in 2007. The days on market is 16 with no offers and no adjustment to the list price. Listing indicates the property's got new AC, water heater, and it's got a 3-car garage. My borrower's looking at this because they have a family, a couple of young kids, and they're looking to basically move up to a bigger home, a home that's more situated for a growing family. So when this borrower contacted me to alert me that he was going to need my help to get pre-qualified so they can make an offer, he told me about the property. And one of the first things he told me was that they were contemplating offering $550. And of course, as I am prone to do now on every occasion when I'm presented with these kind of scenarios, I suggested to my client they should consider an alternative. But in any event, let me first show you what my borrower's suggestion in terms of offering $550, what that would mean in terms of financing. So at a $575 price, they were contemplating a $550 offer. That's a $25,000 price reduction. Also, they're going to be putting 25% down because, again, they've got their current home in escrow, and they're going to have a good amount of proceeds to use for a larger down payment. So at a $550 purchase price that they're contemplating offering, loan amount's going to be $412. The principal and interest at 6 5/8, which I prepared this earlier this week. The rate was that good a couple of days ago. At 6 5/8, the principal and interest is $26.96. Now, of course, what I said was, as you probably know now, I said, well, wait a minute. Try offering the full list price. Don't offer $550 with no seller concession beyond the price reduction. Offer $575, but get that same $25,000 concession from the seller. Get it as a credit that you can then use to pay for a 3-2-1 buy down, as well as your closing costs. Well, in that scenario, at a full list price offer $575, your loan amount's going to be higher. It's $431 versus $412. But look at this. At a 6 5/8 note rate, the principal and interest for that $431 loan amount is going to be $27.60. Again, that's a little bit higher than if they just went with that lower price offer of $550, where it was $26.96. So yeah, it's a little bit higher on the note rate payment. But look what happens with that 3-2-1 buy down. First year, interest rate of 3 5/8. Principal and interest is only $1965. That's $795 a month lower than the note rate P&I, principal and interest. The second year in 4 5/8, $22.16 per month for principal and interest. $544 a month lower than that principal and interest at the note rate. Third year, 5 5/8, principal and interest $24.81, $279 lower than the principal and interest at the note rate. Over that three-year period, the borrower is going to save $19,000 in monthly payments over that 3-year period versus the market rate payment. Plus the fact, with that $25,000 credit, there's going to be money left over because a 3-2-1 buy down is only costing about a little over $19,000.